but it had a huge rise.
It's
30
90 billion.
90. Okay.
His net worth is
Yeah.
90 billion in Nvidia stock.
Okay, that's
It's
amazing.
crazy. Yeah.
Yeah, really fast. So as far as splits go, we have this list, of upcoming splits. You could download, I think it goes back, here's 820 entries. And this would include, though, reverse split. So sometimes stocks also do a reverse split if they're very low priced, like some of them drop and they'll do a
That's
reverse split to make it. So it's kind of in a reverse of,
Yeah, no, that's interesting. I wonder what the results a year after that is.
yeah,
Is it down 25%?
right. I don't have that stat, you know, uh, you could download this list and try to run it, because you have the dates here of, where the split happened. And, let's see how far, so this goes back here in the beginning of the year, or last year, but I don't have the stats, so I can't tell you for, looking at the data. If you're reading that data, maybe you could just check what data they ran, and perhaps, I don't have that in front of me. You'd have to kind of download the data and maybe run that analytic yourself. But I have heard that before, after a stock, especially when you have popular stocks, like, look at, Apple, or, obviously look at NVDA. It seems like after the split, and I don't know this for sure, but yeah, they tend to rise more often. Not sure if that's always the case, but I think Rob's mentioning averages.
Yeah, it's the averages. That's what Yahoo was reporting to. And again, this has been around for years.
Yeah,
That story always comes out after, like you're saying, when it happened with, after a big split, and this
yeah,
is talking in the news, that story always comes out. And it
right.
probably is,
There might
there's
be,
a
yeah,
certain number of people who are playing that strategy.
right, right. And yeah, there might be some truth to it. I don't have like a analysis in front of me to, show you and confirm it. I'd have to run it. And we don't have a tool to do that, because it's not an analysis on a particular stock. It's almost, you'd have to get a basket of all the, the group of historical stocks that had a split, and then track them and aggregate those stats. So, you'd have to compile that information. And I don't have a tool right now to do that. So, um, I can't we can't confirm it through the data.
Well, there you go,
That's
Rob. Hopefully that
interesting.
answers your question.
Yeah. All right. Was there another question or follow up to that? Well,
Nope, no follow-up question.
okay. So let me come back to this tool where we look at the single leg option trades, just to continue the conversation from before, because this is a relatively new tool. And this tool analyzes the option trades that were, tagged as a single leg trade. In other words, they weren't tagged as a multi-leg trade or contingent trade by the OPR fee, right? So that's when a trade occurs, there are certain there are certain tags coming from the exchanges, and one of them is, was it a multi-leg trade, a regular trade, intermarket sweep, and so forth. So these are single leg trades that we're looking at, in this case, NVIDIA, and this is the total volume. So you can see these are single leg trades, 2.2 million, 48 out of 2,972,000. So The rest of them could have been multi-leg trades or contingent trades, and we could analyze those separately. And then when we look at them, we could run different statistics to get, different insights on what happened in those trades. So I'm going to go kind of quickly through this top part because we've done these multiple times last week, so I could get it down to this part. Okay. So in the beginning, this is a breakdown, percentage of calls versus puts. Just lets us know, if calls and puts were evenly traded, or there's a lean towards more calls, more puts. Here, 56% versus 44%, slightly more favorable to the calls. Tagging the interpretation of if the incoming orders were buys or sells. So here the breakdown, 51% versus 49%. Here we look at the conditions of the trades. 74% of them were auto execution, 5% were intermarket sweeps. The other ones didn't have any other tags. The trade price versus the bid and offer at the time of the trade. So here we have a split, 25% traded right on the bid, 25% right on the ask. 20% of the trades were, it was below the midpoint of the bid and offer, but closer to the bid. So not on the bid, closer to the bid. 21% were closer to the ask, but not on the ask. 1% each way were below the NBBO bid or above the NBBO ask, and that's happens when you get a intermarket sweep order. If an intermarket sweep order is aggressive, it can go to a exchange and sweep the BBO book at an inferior price if it wants to take that liquidity and then go to the better priced exchange. And then right in the middle, 6% of the trades happened right on the midpoint. So like from that, just the top part, we get a sense of how people are using the options. Is there an overwhelming amount of selling or buying in the orders? How are these orders getting executed? And how are they getting executed relative where the bid and offer are, right? So when we talk about the bid and offer, that's the at the time where people post, they're willing to buy it at this price, we're willing to sell it at this price, and they're showing their interest where they would want to do it. And of course, once the bid and offers are displayed, we call them firm, meaning that if somebody takes that market, they're obligated to transact in it, right? So when there's and I think somebody was confused before this, what the difference between a liquidity provider and a liquidity taker. So a common expression when we look at the markets, we would describe their liquidity providers and then liquidity takers. And liquidity providers are the ones that are putting out where they are willing to buy it or sell it. That is not automatic, the orders are not marketable, but they're willing to display that on the exchange, indicating to the world what they're willing to buy it for or what they're willing to sell it for. But when you do that, just like you put out a limit order, you're obligated, once you put that limit order in until you cancel, if somebody takes it, we call them market takers, somebody takes you up on it, you're obligated to transact on it, unless you canceled before that happened, right? But once it's out there, somebody could take it, hit your bid, take out your offer. So that's how the exchanges and that's how they view it, as liquidity providers, liquidity takers, and actually they have a different fee structures depending on which role you're playing in the market. So you could if you're playing the role of a liquidity provider, and when you transact, there's a different fee structure than if you're playing the role of a liquidity taker, because usually the takers would pay a higher fee than the providers, but it depends on the exchange as well. So some of them I think have it even inverted. So that's the top part. Then on the bottom part, we have a distribution and some analysis of the contracts, how they traded. This box to the left, it shows the top 5 notable trades. Okay, so this isn't total volume in the option contract. It's something that traded in and it could be big size. Some it could vary by symbol, but these are the top 5 notable ones in NVDA. And sometimes you could have a trade, like for example up here, July 19th, 995, traded 7,761 contracts. And the way a trade may be executed is, if a large trade, let's say you have 1,000 contracts to buy, and if there's exactly 1,000 contracts to sell, well, it'll trade in one transaction, right? So what it will look is one trade. You match up exactly 1,000 with 1,000. Other times you may have somebody who has 1,000 to buy, but there isn't on the other side exactly 1,000 offered, but there could be 1,000 offered in aggregate. So for example, if you and I and somebody else each have 100 offered, 100 contracts offered at the same price, well, what will happen is that 1,000, right, can trade with that entire order book, sweep the entire order book. So what it will look like is many different trades. That's how they get reported, right? Because you have to match up each one of those. And what we do is aggregate it and say, okay, well, here's 7,761 we found that traded, but they could have all happened very quickly, matching up with a bunch of limit order books. So here, what we do is we have these aggregated trades, and then we give you the VWAP price of the trade, 36, and then our interpretation was the incoming order, the taker. What did the taker look like? Was he coming in from the buy side or sell side? Okay. And the top 5 here, the idea is that, is there any kind of particular trend here or something that is noticeable going on? And I'm just eyeballing it here, by eyeballing it, maybe here I see the same option traded twice. So May 31, 1020 call, here's sold here, and another one here sold at 2 different prices, 32.55, 33. Maybe that's something to look at. Maybe somebody has an extra grind. Maybe they're liquidating a position. Maybe they're doing buy. So you could look at it and see where the implied volatility got pushed on that. And I don't see, just eyeballing it, nothing else particularly sticks out. I see. No, never mind. I thought maybe it's something else, but that nothing else right now sticks out at me. Let's move on and see what the distribution of the trades looked like by the delta of the option at the time of the trade. And the idea here is that if we look at the trades and were they occurring, at the time of these trades, are they mostly near the monies? Are they going after wings, which would be, somewhere between, let's say, the 25 delta to the like 5 delta, where they're out of the money, but they still have some delta to them. And then you got the very out of the money tails, which we consider less than 5 delta, which you really need a much bigger move for those to we would say like almost like you need the stock either to move violently or to gap. So these are the distributions here, and then we have the in the monies. So the distributions here is we see about 10% of the trades are in the call wings, 9% in the put wings, very similar. One that sticks out is maybe at the monies. That's where most of them look like, 28% of the calls are in at the monies. We got 17% of the puts that are trading near that money. Here are the tails, so more put tails than call tails, 12% versus 17%, and not a lot of in the money trades, but the ones that are current, they're mostly in the calls, 6% of those. So that's just the distribution of the options, how people are using them relative to, where is the stock versus the strike prices. Then we have a distribution of, the size of the orders. How are the size of the orders typically coming in? Do they look like, small traders, like, less than 10 contracts, and also less than $2,000 in notional. Then we got like retail traders. Sorry, these are less than 10,000 notional. We got retail traders that could vary. There's some retail traders could trade $20,000, $30,000 and then some in the lower range. Then we have like a proficient trader here, and then the very large traders. We're looking at contracts over 500. I forget what it is, maybe over $100,000 in notional. And this is the distribution just to see, the typical order size coming in and how those are distributed. So you could see here a lot of them are retail traders, small and regular retail trade size. This over here shows us the distribution of trades based on the different exchanges that it could transact. So most of it here is in the ARCA and NASDAQ. And then you got Philex and so forth. And this gives you an idea like where the trades are getting routed to, where they're transacting, where there could be possibly better price improvements and so forth. So this is a really quick reference for that. Then I'm going to scroll down here. Actually took me longer than I thought to review it. So really quick over here, this gives us a couple different insights. It shows us where the options are trading and what's happening to the option prices relative, if we put them relative to implied volatilities. So here we see the biggest percentage of the options are trading right in May 24th. And the table is down here. So this is the table with the volumes. This is just a graphical representation of it. So 56% of all the volume is in May 24th. The next one you can see here, it's going out May 31st, 16.8% of the volume. And it kind of like just keeps tapering off. And what's happening in the options, we could take a look at the implied volatility and the implied volatility change from the previous day. So here, see these red dots? That's what the implied volatility curve looks like now. And this gray line is what the implied volatility curve looked like the day before. And what this allows us to do is compare the volume in the trades versus how's it impacting the markets? How's it impacting the implied volatilities and the options? And the red dots is telling us that the implied volatilities, and this is looking strike to strike. So this is strike based, not delta based. So we could look at the implied volatility changes from two different perspectives. We could look at what is a 50 delta option yesterday versus a 50 delta option today, or we could look at what is a 100 strike yesterday implied volatility versus a 100 strike implied volatility today. So this is looking at the strike based comparison. And what we see is that the implied volatility curve dropped. And that makes sense because NVIDIA reported earnings. So implied volatilities dropped. Where did it drop the most? Well, we see that the front months, the implied volatilities was pumped up the most. So you could see here the drop from the previous day. And the implied volatility curve now looks more normalized. It's not, it's not sloping, steep going down with this steep slope. Now it's more normalized, looks more like a normal curve where it slopes slightly higher as you go out further in time to reflect that there's more uncertainty as you go out further in time. Okay. And this just lets you visually compare what does the term structure look like and how did the term structure change from the previous day. All right. And if we go down here, now we could analyze a little bit more in more detail. We could look at the actually, well, we're right at 9. I didn't realize that it took this long, but what I'm going to do is next time, because there's a lot of information on this table alone, and this table here lets us analyze within each expiration the implied volatility skew by strikes. Okay, if we click on it, and it tells us the changes in the implied volatility skew from the previous day. So when you click on it, you'll get this. Okay, these are the different strikes on May 31st.
And we did have some questions pop up at the end where it's a little bit of a day. One from Mike asking, would you consider pro or a large trader smart money, e.g. banks or institutions, is one of the questions. And obviously, let's not get to them today. We'll get to them on Monday. And Rob was asking something about the IV line. So I'll copy those and send them over to you for, we'll continue this on Monday.
Okay, sounds good. And so everyone stay safe out there. Have a great trading day. Have a great weekend.
And it's not Monday, actually. It's Tuesday. Monday's
we have
the
holiday weekend. Everybody enjoy those 3 days. And we'll see you guys on Tuesday, and we'll try to get to those questions.
Have a great Memorial Day, and thanks to all those who served. I see Chuck in the group. I think he served our country. So everyone have a great holiday, great trading day.